When we typically analyze market structure, we often rely on the broader highs and lows to define our trading ranges. But candle range theory introduces a compelling idea. Every individual candle on your chart actually possesses its own distinct range. This concept makes a lot of sense. Think about it. If you zoom into a daily candle on a 1 hour time frame, you'll see its wicks effectively outline the 1 hour swing low and swing high, creating an isolated range of its own. While this might seem like basic market analysis, when we combine it with smart money concepts, the single candle framework can pave the way for remarkably consistent and high profitability trading opportunities. In this guide, we'll break down everything you need to know about candle range theory into 5 straightforward steps. Let's dive in. Step number 1, identifying trade setups with CRT. The typical setup for this strategy usually involves 3 candles, each playing a critical role. Let's start with the first candle. Imagine a bullish candle on the daily time frame. We can visualize its price data with increasing precision as we move down to lower time frames. However, for this strategy, all the essential price action data from these various time frames can still be found within that daily candle. It tells us simply that during that specific day, the market opened at a certain price, closed at another, with the highest and lowest prices marked by its wicks. In candle range theory, both the top and bottom wicks are considered their own isolated liquidity levels, serving as potential targets for subsequent candles. This is a logical assumption because if you observe any chart, you will notice that most individual candles tend to attack either the previous candle high or its low. So the first candle in CRT is purely used to define the range. That's where we're interested in trading. The upper liquidity level is referred to as the candle range high, and the lower liquidity level is the candle range low. You can actually use any candle on any time frame to define a tradable range, although we'll discuss criteria for ideal candles later. Now for the second candle. This is where the setup truly takes shape. The core idea behind CRT is that if the price attacks the central range high but fails to close above it, there's a high probability that the candle range low becomes the next target. So what are we looking for? The second candle should push up above the high of the first candle, then pull back into the range where it ultimately closes. This liquidity sweep is crucial. If instead the second candle were to close above the high of the previous candle, the potential CRT setup becomes invalid, as the market is more likely to continue its upward momentum rather than targeting our first candle low. If the criteria for the second candle are met, we can then look within the third candle for an entry setup. We'd typically aim for a short entry with our initial target being the candle range low. Of course, you can extend your trade if the broader market structure supports it, but once the price moves past the candle range low, we consider the setup complete. We've covered the concept, but how do we actually enter trades? Let's zoom into the lower time frame to see an example. Here's the price action of our first daily candle, complete with the buy side and sell side liquidity levels established by its high and low. As we transition to the second daily candle, the first thing to notice is the sweep of the buy side liquidity before price retreats back into the range. This is significant because a sweep of buy side liquidity often indicates that the market will next target the sell side liquidity. This liquidity sweep marks the first phase of our setup. The next piece of chart structure we're looking for is a change in state of delivery, or CISD, where the price pushes below the bullish leg that initiated the sweep. This signals the strengthening bearish momentum, which is exactly what we want for a short trade. Finally, we want to see a bearish fair value gap formed during this bearish leg that created the change of character. This fair value gap will be our preferred entry point. To recap, the first daily candle defines our trading range. We then analyze the second candle to see if its market structure aligns with our criteria. This leads us to the third daily candle, where we can look to place our entry. This simply involves shorting the bearish fair value gap with the candle range low as our target. It's worth noting that many traders using this system choose to enter on the break of the second candle low. However, as we know, breakout trading carries more risk than utilizing internal range liquidity for entries. If we anticipate a lower move, the fair value gap offers a much better entry price. Once the price hits the first daily candle's range low, the 3-candle setup is complete. We also have a bullish variant, which follows the same principles. Here we're looking for manipulation at a bearish candle's range low, with the ultimate target being its range high. Now let's go into step number 2. Beyond 3 candles, the AMD model. A CRT setup isn't strictly limited to 3 candles. We started with a 3 candle example because it's the simplest way to explain the concept. However, in reality, there's no fixed rule for how many candles a setup might involve. The key criteria is that the market structure clearly displays an AMD formation. AMD stands for accumulation, manipulation, and distribution, which are the 3 phases of the smart money concepts model, known as the power of 3. We look for our trade entry during the distribution phase, but only after the 2 phases have been confirmed. Looking at this chart, you can clearly see the AMD structure we seek. We have the first candle, which defines our candle range high and candle range low. Following this, we see a few candles that haven't moved price significantly in either direction. This is the accumulation phase. Then a subsequent candle creates a liquidity sweep. This is our desired manipulation phase. Remember, it's crucial that this candle closes back within the range. Otherwise, the potential short setup would be void. Finally, we observe 2 bearish candles that attack the candle range low. This is the distribution phase that completes the setup and where we would look for an entry after the manipulation phase is confirmed. The key takeaway here is that the most important aspect of the strategy is identifying the correct market structure, specifically in the form of an AMD model. With this understanding, you can even find setups involving just 2 candles. To illustrate, we'd need to examine that second candle on a lower time frame. Again, on the lower time frame, we can see another AMD model, an accumulation phase followed by manipulation in the form of a liquidity sweep before price pushes down during the distribution phase. In terms of market structure, notice how price creates a CISD after the liquidity sweep, then uses a bearish fair value gap as a catalyst to attack the candle range low. Step number 3, pairing timeframes for CRT entries. Now that we understand the concept, it's vital to know how to plan your setups. Consider a chart on the daily time frame. You can see price has attacked a buy-side liquidity level with our knowledge of SMC. We know this is a pivotal moment determining whether price will continue to push up a liquidity run or push down a liquidity sweep. This makes it an ideal scenario to use CRT to analyze this candle and discern the market intent. With the candle range high and candle range low drawn out, we know that if the following candle sweeps the range high, it's likely then to target the range low. However, simply observing this on a daily time frame doesn't provide enough detail. While it shows the second candle's open and close, it lacks the crucial market structure needed to justify a trade. This is why it's essential to understand that we only use the higher time frame to define the candle range high and low. We then move down to a lower time frame to actually break down the market structure and identify a tradable setup. This process is called time frame alignment, and it's fundamental to every SMC setup. For those unfamiliar, here are some optimal time frame pairings. If analyzing a monthly candle using candle range theory, you'd look within a daily time frame for ideal market structure and potential trade setups. If analyzing a candle on a 4-hour time frame, you'd seek entries within the structure on the 15-minute time frame. And for step number 4, when looking for entries, you should be targeting the ideal equilibrium of the higher time frame candles. As we've established, a single candle represents its own isolated range on a lower time frame. This means we should trade a CRT range just as we would any other range. If we're using a bullish candle to define our range, we'd naturally be looking for a setup to take a short trade. This implies we'd want to seek entry opportunities within the upper half of the equilibrium of the range. Conversely, anything below the mid-level would invalidate our entry. With this in mind, as we advance in time to see the next 2 daily candles broken down on the time frame, a fair value gap presents an excellent area for a short entry. It meets all our market structure criteria and is located within the upper half of the equilibrium level. On the other hand, if we're using a bearish candle for the CRT range, we'd be looking for a long entry. This means you'd want to find bullish setups within the equilibrium level, which is anywhere below the 50% equilibrium of the range. This approach ensures you achieve the best risk to reward for your trades. Finally, step 5, understanding when to use and, crucially, when not to use CRT. The concepts behind candle range theory are very powerful, but only when applied under the right circumstances. For example, here we have a bullish candle followed by another candle that has created a liquidity sweep on the candle range high. Based solely on this information, we might expect the third candle to push down into the candle range low. However, while the setup might initially appear promising, a critical aspect often overlooked by traders is ensuring the setup makes sense within the broader context of the external market structure. Now that we can see the full range from which these candles originated, a closer analysis of the chart reveals that the CRT setup is highly likely to fail. Why? Because for the price to push down past the candle range low, it would need to overcome this bullish fair value gap, which also happens to overlap with a bullish order block. With this further analysis, our buyers should actually lean more towards being bullish, which contradicts the idea behind the specific CRT setup. As expected, when we move forward in time, the setup does indeed fail due to the strength of buying power found in the bullish key levels. Consider another scenario. Here's another potential candle for CRT setup. This time the setup holds significant potential because it has occurred at an important point of interest, specifically a liquidity level. The way we should think about candle range theory is that it's essentially a method to signal a reversal in the price direction. This makes it an excellent tool to use during a liquidity sweep, as it can help us analyze whether we're witnessing a liquidity run or a liquidity sweep in real time. Another powerful application for CRT is when the price is drawing into a key level, such as this bearish fair value gap. The reason is that after a change in state of delivery, we should already anticipate the price is likely to reverse from that zone. Therefore, we can use candle range theory to find confirmation that this fair value gap is being respected. The key takeaway is that candle range theory can be an incredibly useful tool in your trading analysis to identify and trade reversals in the market. However, it's equally important to understand when you should actually use it. If you enjoyed this video, subscribe to this channel, give us a like, and drop down in the comments below what kind of content you would like to see from us.